afternoon. It's our 3 p.m. as always. So Saturday 3 p.m. is a always knowledge exchange time we offer to the community. So a lot of times when you handle your own financial affairs, you're doing your own business, what you don't know is what you don't know. If you don't know, then you don't know how to implement. You don't have to know everything, but we want you to hear the buzzword. We want you to hear just the concept because those concepts will make you smart. Once you understand the concept, and you're going to post questions to your tax preparers, to your financial advisors, whoever you work with, then they will have to be able to tell you why they're not using what you think it should be done. So today's topic is Golden Triangle for real estate professionals. Real estate professionals are defined as what? As someone who are dealing with real estate matters day in, day out. So professional doesn't mean you have to get real estate license to buy and sell on behalf of people. Real estate professionals are the people who dealing with real estate matter day in, day out. For example, you're a landlord. For example, you are a consultant, knowing that where to buy what properties. Like Best Buy, they actually hire a real estate professionals who are doing data analysis to tell them how much of a population, where they have, and where to build a Best Buy store. So those are professional work. So anything related to real estate, it is real estate professionals. So now let's get going with what we have planned for you. So I'm going to share screen. I will share this screen with you. I know you are actually looking at our YouTube channel, but my whole purpose is to bring you to the PowerPoint that I prepared. Then shortly after that, we go into drawing board because we will conclude our session with the drawing board so you actually know exactly what I am talking about when I say golden triangle. So these couple of slides are slides that we use to introduce our firm. Bear with me if you are the first time coming to our webinar. It is important for you to know who you are listening to and whom you are working with because so many knowledges are floating on internet. If you're not careful, the knowledge you get could be misleading, and it's not wrong knowledge you get, but it could apply that wrongly on your own case. So this is our website. You can always get on with us to get professional advice. We have 40 people in our firm. We speak 10 different languages. So I myself, I speak Chinese, but we have staff speak 9 other languages. And here on our website, you see that blue button called On Board with Us. That button allow you to become our client without needing to call for a appointment. You get on that web page, you register yourself, you're uploading what you need us to look at, then we go from there. Appointment button is where you are making appointment with us. We have video appointment with partners. You can choose any one of us to have a meeting with. And if you choose me, and my session is 45 minutes, and the fee on that one is 375 per 45 minutes. So, but I promise you, I have been using the appointment button for maybe 5 years to 6 years. I have never had anyone who would come out of the session thinking $375 is overpayment. No, we give you the knowledge right away. We don't save what we know, not telling you. Here is when you click that appointment button, this is the partners we have. So you can choose any one of us in any of the special area. For example, Dr. Howe, and he's actually specialized in governmental program, special program, compliance audit. If you get audited by Department of Labor, you get audited by IRS, you get audited by the state, you got scared thinking you're gonna go to jail, and he is the person to go to. We also have, of course, myself. I would call myself a tax strategist because obviously I actually don't do taxes. I don't fill up the tax form. I have done that for 20 years. I'm done with that. But what I do is to elevate that knowledge from that form for you so you can implement. So that is what I am good at. And then, of course, we want to tell you this is our YouTube channel. You subscribe to the YouTube channel, you get the knowledge right away. And a list of our firm information, I'll just get through this one really quickly. We have 5 branches. I just want to mention that to you. Houston, Texas is our number 5, and we started this one from last year, July. So we're still new to the city of Houston, and we would encourage folks to explore our potential, knowing that what we know, it would be important. I am also an author, just you, if in case you don't know, I wrote 2 books already, and I'm working on the third one. My books is a business book, but it's not boring because I use community CPA as a storyline, then coupled with client story to talk about how to start a business, how to grow business, how to expand business. That's the 2 p.m. I'm writing right now. And then the 6 p.m. is how to retire from your business. Sometimes I think that we don't need to be taught how to retire. Who doesn't know how to retire? Everybody knows we just lift our feet up and just sitting there doing nothing and relax, right? But how long that gonna last you? I think you're gonna get back into golden triangle scenarios the second day. I actually don't know anybody who really retire. The only time I really see them retire is they're dead. Otherwise, they keep on working and they keep on dreaming up troubles, adventures, and life is just supposed to be exciting, right? Life's supposed to be this way, and I don't debate that. And no responsibility disclaimer. This is just to say that what we give you, free knowledge, and you want to digest it. You want to really place your personal judgment on it. And don't be shy. You can say, Yin, you are wrong, completely wrong. And I'm really okay for you to say I'm wrong because my scenario may just not be yours. So understand that. And I'm totally cool with that. But just please don't use any knowledge you got from internet and apply to your own scenarios without absolutely certain that is correct for you. Now, I want to give you the objective of today. Today, we want to understand different entities, how they function in different tax structure. Okay, so that's the golden triangle. It talks about 3 basic tax structures. So we want to understand that. We want to understand fiscal year versus calendar year. What is fiscal year, right? What is calendar year? January to December. So what's the big deal? Such a big deal. So we can talk about that. Understand how accounting method works for the tax filing. Is that a big deal? Such a big deal. But if you are sitting there goes, I never heard of it. I don't think it's a big deal. Then you're missing out so much. Maybe I cannot even estimate it for you. But I'll tell you one estimation. One client came to us for 3 years tax change because their accounting method was wrong. So we made changes to their accounting method. They got back $275,000 IRS federal income tax refund for the amendment. That is how big of a dollar difference can be. And know how to build your own golden triangle. So that's our objective today. After this session, we want you to know how to do that yourself. So now I am going to stop sharing this PowerPoint. I will go to my drawing board. A lot of folks, when they work with me, they enjoy the drawing board I give to them because they felt that's the only way they understood what the complex tax structure offers them. So what we have is a plain white piece of paper. So we are going to draw that golden triangle, and then we're going to talk about how it works for you as a real estate professionals. We already talked about real estate professionals, right? We know that the real estate professionals are people and who hold on, why it is not I am trying to click something. Okay. I will try to see whether this is giving me a hard time or what. Good. All right. So now what I do is I am going to draw 3 boxes on my map. Not perfect drawing, but it will make perfect sense. Just wait for it. All right. With the first one, this is the golden triangle. You see that? The reason it comes into the triangle because it goes back and forth. Same thing. And to know that these structures are all yours. So we're not talking about you're forming a golden triangle with a third party. So this is you and your spouse, your children, or you and your brother, your sister. We're talking about the family. So the first one I want to focus on is the top one. So the top one in the real estate professional world, what people do with that top one is to make that a holding company. So you may say that, oh, Ying, what does the holding company do? The holding company basically holds something for you. It can hold your title. It can hold the ownership. It can hold your bank account. So holding company is a company that holds your asset. And so your asset is not exposed to anywhere else. It just stays right within the boundary of the holding company. So what type of tax structure a holding company normally is? Normally is a LLC, a partnership. So now if you do have a partnership, let's say you and your spouse, you both have this holding company and you will put the purchase of your property under the holding company. When I say you put the purchase of your property on the holding company, what do I mean by saying that? I mean the following things. Number one, you need to form your holding company. Number two, when you close the purchase, the title need to be under the holding company. So that is what I mean by put your house, your investment property in the holding company. What is the holding company going to be responsible for? Only 3 things for this property. Number one, insurance. You want to buy the insurance for your property. The beneficiary of that insurance should be the holding company. Just in case this house burned, when the insurance company give you the proceed check, you deposit that into a holding company because this is your title holding company, right? You're holding the title. So insurance and what else? Property tax. What else? Mortgage. Interest. Those are the things as an owner you hold it tight because that is your thing and you need to make sure that you pay all of these. And another one is the depreciation. Depreciation is not a real expense, right? It is an expense that coming with the property itself. And depreciation has different rules, so you can depreciate differently. But these are the fundamental expenses. And you notice that all of these expenses does not have any risk in terms of claims. What I mean is the insurance company not going to just walk into you and it goes, your house is mine. And the property tax county not going to sue you for that. And the mortgage company, as long as you pay the mortgage, they don't come over to bother you. Depreciation is a phantom expense. It's not a real expense. So you don't have a risk for losing your property because there would be no other people's claim. So what happened to my tenant, you might ask, right? This will lead us to another tax structure, which is right here. So this is where your tenants are. Your tenants should only know this entity, not the holding. So on the holding side, I want to continue with the holding because we set up this structure. So we know that, oh, at the end of the year, and with all of the expenses, I actually need $15,000. I have $15,000 expense. So all the tenants are paying all the rent is here. The tenants was paying like $115,000 on rent, but I am paying 15 over here. I needed this company to pay that back to me. So my management company right here would pay a 15,000 to us in here. We go into here, so this one is income. And the money goes out from here to here and it's become income over here. So it is offsetting the losses here. So you are getting a 0. So the goal of holding company is relatively 0. That should be a goal you constantly go. So your holding company would actually, at the end of the year, issue what? Issue K1, right? Where is the K1 goes? The K1 is actually coming into, what is this? This is 1040. The K1 is actually coming into the 1040. It becomes a 0. So it named, calling this triangle a golden triangle is with a reason. And because it's golden in terms of saving your taxes, why do we really care about this one to be close to 0? Because when you have a partnership tax return, you have to determine between you and your spouse and who is active, who is non-active, or both of you are active, or both of you are non-active. Why do I care about that? Because this person who is active, and if you had a gain, if you have a profit, you would end up paying 2 taxes, income tax and self-employment tax. So this K1 coming out of partnership to 1040, always there is a determination whether you pay self-employment tax or not. It can get complicated. For example, if you have a gain on here, let's say we didn't do the expenses, so we got a gain of 15,000. The 15,000, if you don't manage the 15,000 gain properly, it will be not only paying income tax. So assume our income tax rate, I would assume that 20%, this is national average, okay? Actually, it goes all the way up to 37, right? But I'm just giving you the average. So the self-employment tax is 15%. So if we add these two up, you have 35%. So if we have 15,000, I'm doing calculation on the side here. So if I times 35%, so I got 5,000 $250 taxes to pay. But if I don't have the 15%, then I have only $3,000 to pay. You see that difference between having self-employment income or not. So 1065 is notoriously sensitive to that determination. IRS, when they audit your 1065, they actively looking at opportunities for you to pay more taxes on the self-employment side. So with that said, people say, okay, I'm not active, but you have to prove you are not active. If you have a full-time W-2 income, then that's easy to say you are not active, right? Because you only work spare time. But if you are non-active, you also have a bad news. If you are non-active, sure, you don't have to worry about paying income tax because you have a loss, right? You don't pay self-employment tax because you have a loss. These are you don't. But the losses don't come out to offset your W-2 income. Let's say your W-2 income is $100,000 and you wish that you got $50,000 loss here. And how you wish you can reduce the 50K here, then you pay less taxes, then you get a refund, right? You wish that. But because of your income is too high, so the loss is disallowed. When they allow your loss, the maximum is 25K. You see how the losses is being manipulated into many roles. So the holding company in this concept should focus on getting it to zero. Now, let's come to our management company. What kind of company would this one be? Okay, now Ying, you said the title company is LLC. What about management company? This one, I would call it S Corp. You know, I tell people that Golden Triangle, of course, I give that name, but the concept itself, I did not create. I can only tell you that I witness these concepts so prevalent to the American folks who are generation in America. They know the rules. And when you talk to new immigrants, people who got rich in this lifetime, they are the one doesn't understand what's all behind on the tax history. You know, our firm, Community CPA, we started at the place where homogeneously it's just Caucasian population. So with that, we actually really don't have, in the very beginning, when I started the tax practice, I am practicing with farmers and generation of Americans and renounced and significant politicians. So we know what we are doing. I understand the history of the taxes. And myself, I actually practice taxes in Canada as well. And I have significant clients from Australia. So the understanding of taxes to me is very international. It is very much on the global scale. So when I look at tax rules and regulations, it makes sense to me. Sometimes I can see how country and after countries are copying each other on certain tax policies. Then you can see that a lot between Australia to Canada and between Canada to US. So with that said, and when I talk about these rules and regulations, and it really at home for me. So I want to translate that easy understanding to you as well. So when you hear me, I know your understanding is not about a form, but your understanding after hearing what I'm saying is very global. But that is what you need. You don't need to know all the forms. Which form related to S corporation? Oh, 1120S. Oh, what about the property, the properties, and what kind of form is that? And so you don't need that. You only need to tell your tax people to know that, but you need to know the concept. So our management company need to be S corporation. I say need because this is just fixed. This is the best choice for you to be on S Corp. So with S Corp, you are running from January to December. Same as your LLC. So towards to the end of the year, you're going to look at all your expenses like this one, right? And because you know how much you are paying right here, at the end of the year, you know how much you need to make this entity to zero. You know it. So you know how much you need to pay up to this entity. You may say that, Ying, okay, I write a check, I pay to the LLC. What is the category of that? It's occupancy, usage right. Because as a management company, you were granted to use these property. You don't own them. You have no right to the property. So when your tenant decided to sue you, you got nothing but a bank account. So hopefully you don't have a couple $1,000,000 in that bank account. Then the tenant should sue you. Your first defense is your insurance. Insurance should cover you. If the insurance failed to cover you, for example, you didn't pay premium, your insurance wasn't even there. That happened to me before. It happened to my car. I got a wind damage to the car. By the time I needed to repair, realized that my agent just completely forgot I have a car was never insured. So, that may happen to you. So you realize that you have no insurance. Then your second defense is your corporation. So if the demand is so big, is bigger than your bank balance, then you fold your S corporation, you walk away clean. What happened to your property? They are here. They're here. They're not part of your S corporation. This is golden, right? This is golden. This separate the risk completely for you. Risk, separating the risk. There, no risk. Here, yes, risk. You have a risk because you have other human beings involved. Risk normally doesn't come just windfall. If it is windfall, hopefully you do have flood insurance, earthquake insurance, terrorist insurance, whatever you want to call it. But when you get people involved, here you come a real risk, right? So you have your management company and you are doing the usage payment back to your company. So you got expense, then you come with a profit. So let's say our profit is 100K. Now, without the other leg, we end right here. We got 100K. So what's going to happen? Now the 100K is issuing K1. Where did the K1 go? The K1 goes, let's find the best route to go over here. The K1 goes all the way to your 1040, right? Another K1, 100,000. Then you may ask, okay, Ying, what's the difference from the first K1 0, this K1 100,000? What's the big deal? The deal is so big because this K1, if you have 100,000, you pay so much more taxes. Remember, we were using 15,000 as an example. There is a 15% more taxes over here. But this K1 is immune from the self-employment tax. It doesn't even talk about that. It's not in their vocabulary. It's not in this life. So the S corporation don't understand what is self-employment income. The S corporation goes, what? That is a distribution. Distribution does not pay self-employment tax. So your 100,000 just what? Your 100,000 is very simple. It's just gonna pay income tax. So you save right there the 15. What else you save? You save the struggle of determine active, non-active. So it just flat, consistent. It just as corporation, with a distribution, here I am. Now, S corporation has a special rule, and S corporation is a corporation calling for W-2. So the S corporation says that, well, if you are a S corporation, someone must be working in it. So that person who works in there, if it is a shareholder themselves, they need to pay themselves a salary if the company make money. So true. But if the company is not making money and the owner decided not to pay, that is totally understandable, totally fine. You don't have to run yourself a payroll if you're losing money. But if you lose money, let's say you lost 100K, then the 100K will come here as a loss. If you had your W-2 as 100K, then your this year's income is zero. So all of the taxes you paid will come back to you equals to your refund. This also reflected on 1065 partnership. Remember, if we have a loss, we have a limitation. Remember? And we are disallowed because we're making too much money. That doesn't happen with S corporation. Allow you to have a loss. And there's no discount on it. So you can bring that right in as a loss right here. So we are resting in the comfortable place to have a gain, have a loss. But if we have a gain, we need to think about W-2. So let's say you made $100,000 profit and you add yourself, you are the shareholder, and you have a couple of workers who follow you that does the maintenance for you, your repairman, but they're not W-2, they are 1099. That's fine. We're going to add them because they are your worker, right? So let's say all three of you are working full-time in the company. So your 100,000 profit divided by 3. So each one of you each one of you contributed to $34,000 profit. Am I right? So for the owner, you only created 1/3 of that profit. So you can split that 50% to W-2 and 50% treat that as your distribution. So your distribution would be what? Would be 17K. So plus the other 34. So you actually would get 83K as a distribution. Because the other two are workers. They don't get they don't get distribution. They are not shareholder. And so you will pay yourself 17K W-2 and 83K distribution. So here your K1 is 83K and your W-2 is 17K. And right here, I want to say to you, if you come to our firm, you say, Ying, okay, I pay 83K on the distribution, but I don't want to pay the 17K on W-2. Can you get rid of that? The answer is yes. We can actually move that out to be non-taxable. I won't go further on here just because it's literally another subject, how to make S corporation W-2 for the owner to be non-taxable. But yes, you can do that. All right. So now I just kind of laid out the golden triangle through 2 legs for you, right? So you know how to make your title holding company 0, and you also know why we need a management company to be S corporation. And look at how much taxes we would save by moving it around and have the management side just do the management, have the holding side just hold the title. So if the tenant is not happy and suing you, and yes, it's okay, you got your business insurance here, so the insurance will come in as the first defense. Then after that is your bank account. I say it is your bank account just to make you kind of understand that it's your S corporation's bank account, not your personal bank account. It's your business bank account because you got no asset, my dear, in the S corporation. Now, let's touch on the third, the third leg of this triangle. What is the third one? We all know that when we get into real estate side of renting, oh, you bought a home, you rent, life goes good. You bought another one, you rent, life goes good. Then you bought your third one, it is so shabby and broken down and you have to fix it. So you decide to flip that house. When you got into that thinking, maybe you're not doing flip, maybe you're thinking of to fix it, then you rent it. Maybe that's what you're thinking, but at the end, someone come around and goes, I don't want to rent it, I want to buy it. Then you ended up selling it. So when you are in that kind of mindset, there is another kind of company we need you to do. So that one is called a C Corp. And it's also called fiscal year C Corp. The reason I say this to you is, you know how you buy properties? You don't buy it on January the 1st. And you don't just buy it on January the 1st and then go down to December and file taxes. You probably bought it in November. If you buy the property in November 1st, you start to fix it. By December, you bought the property for 20,000, and you bought that on November. And in November that month, you put in $10,000 fix. December come around, you put another 50,000 into fix, and you already out 80,000. Can you deduct it? Can you actually reduce this 80 out of any of your income here against your W-2, against your S corporation distribution? No. This is a C Corp. I set it up for you. So this 80,000 stays inside of the C Corp, and this is your expense you cannot deduct. Then you probably wonder, well, I wish I don't have to conclude the year in December because I'm going to sell it in May. It's not going to take very long. I finish it. So January come, I put in another 10,000, and February, March, this is Chinese New Year's. I don't do anything. So April come, and I am putting in another 10,000. So now my whole house cost 100,000. And in May, I sold it in 120,000. So at the end of May, I got 20,000 profit. Look at your timeline. You actually finished that flipping in 1 year. But if we were going to do taxes regularly, like in the calendar year, you're going to report that as of December, that's one time. Then another December in next year as another time. So you have a operation that's less than 12 months, but broken into two separate tax reporting. The first tax reporting doesn't do anything for you. The second tax reporting, and you got your 20,000, then, you pay taxes right there. What would be a better choice for you? The better choice is to look into fiscal year, which means that we're going to set up our company. The first day is November 1st. The last day is October 31st. Think of that. When you do that, and then you have your operation running, by May, you already sold profit, but you are not yet time to file taxes. So you can purchase another property. And you can go on for another flipping. And if you only flip this in 3 months' time, in a proper year, then you would flip that almost 3 times. So having the first setup be right, for the C corporation with a fiscal year, that will be your golden key to make you not struggle, try to report any income and losses for a partial time. The other thing we want to add in here as well, other than the fiscal year, and then we want to also figure out, now we bought it for on November 1st, we bought for 20,000 and we fixed it for 80,000 total. So that's total fix, the total fix. Now I want you to look at the S corporation. I am making $100,000, but I give a lot of advices, and I really, you know, trying to figure out now if I can add more expenses to here to reduce my gain, right? So you can work between your companies, from the holding company and from the S corp. The holding company might not contribute anything because they don't really doing any practical things. The title of this flipping house, if it is in here, you would have a relationship with holding, but you can also put that in here. Then you control the whole aspect of construction for this house. Now, we want more expenses coming over here, more expense, because we want to reduce the profit here. If we want more expenses over here, obviously, over here, we are looking at increasing profit. Of course, in our example, we're making $100,000. But what if we are actually not making that much and we want to make certain money, and then we will have expenses over here, 50K, we would increase income over there. This is all your company. Remember when I start talking, all of these companies are structured separately on its own, but the ownership is all the same. The tax structure is different. So in here, remember, your profit is not exactly just what you spent minus what you sold minus your expense. Your profit can be an estimated number. Let me explain to you. In the flipping company like this, you use accounting method. Your accounting method, you can use completion method. What do you mean by that? This is what I mean. So I believe that this house I bought cost me 20,000. I budgeted for $80,000 expenses, and I budgeted for 120,000 to sell. This is even before it happened. I already budgeted this way. So that means completion method just means by the time you reach the 120,000, that's the completion. Anything before this time, and you will do proportion. So for example, and we spend the 100,000 because it is all spent it. So that's why the 20,000 is 100% completed, it's become a profit. But what if we spend only 50K? Then our completion method is what? Is 10K profit? So you would take in the 10K as profit to your tax return if you have to end your construction in the year. But again, most of the construction, when they are bigger, they're more than a year. So they want to start at fiscal year, and then they want to count to the full 12 months, then conclude that with the completion method, then go on to the next year. So this C corporation right now, the tax rate is 21%. What is the Trump's promise? 15%. So this company could very well be paying just 15% versus our personal tax rate is 37. With 15%, I know what you're thinking. Some people say, Ying, you forgot to mention about double taxation. It's double taxation, so it's not good. Whoever used that word, I try to tell people that if you hear anyone talking about double taxation, because these people are big shots. They are the people doing accounting taxes for public company like Amazon, Google's, and Microsoft. They're big deal. They're the one doing Tesla accounting. They care about double taxation because they are public company. They have to declare dividends to the public shareholders. If you make money, you don't declare dividend, that's not right. I'm a shareholder. I'm a minority shareholder, right? I bought your stock online. You should treat me right. So those are issues there. So SEC regulate them, wanting the company to pay dividend, so the dividend will be paid out. Then the owner of those big company, they already paid company taxes. They will take home the dividend tax, which will be another 20%. So they're saying that, oh, 35%, I am paying double taxation. Guess what? They are still so much cheaper than paying personal tax rate. Personal tax rate for those big shots, they are paying 37% plus 3% of investment and a plus whatever they're disallowed for the deduction. So it is, their QBI could be disallowed. So there is a lot more taxes for them to pay. You see, if I just add up here, on the federal it's already 40. And even if I pay double taxation and it is 20% on capital gain tax, which is dividend tax, the maximum goes on the 20%. And so that would give me 41. It is actually going to end up cheaper. I know it is 1% difference, but that's because I didn't add anything else that they were disallowed when they get into 400,000 and above AGI. So what I'm trying to impress you is, as a small business owner, we don't worry about that. There's no double taxation for us because you will plan your taxes in such a way that you don't get double taxation. Even President Trump don't get double taxation. So are you richer than President Trump? No, then you don't, right? So with that said, and what happened is your profit is something you can manage. You can manage this profit on the C corporation from two aspects. One is fiscal year aspect, the other one is accounting method aspect. The accounting method is a big deal, right? I'm just talking about one. There's cash method, accrue method. These are all things waived into your tax return. If you are doing your taxes with your tax preparer and you have never ever have this person ask you, oh, what kind of accounting method we should go with your business? If that didn't come out as a question, you may be missing out a lot because that is an important question. When you go to the attorneys to form a business entity, if the question of, are you going on calendar year or you're going on fiscal year? Is there any benefit for you to be under fiscal year? If that was not a question come to you, you might be missing out a lot because that is such an important tax strategy that you need to have in the golden triangle. You may end up just be January, December. I'm not saying that you can't, but a lot of times I don't think you buy property on January the 1st. That's why I say your entity most likely is fiscal year, and C corporation can set it up as a fiscal year. But the other entity like LLC, S Corp can also set up as a fiscal year. But the thing is, you have to prove that your 25% of your total revenue are concentrated in 2 months' time. If you can prove that, you also can be a fiscal year set up. All right. So with that, we got a little construction going on in this area, so you can hear that. So with that, it's kind of give you an idea of how these different entities play into your favor. That C corporation can shelter everything away from you, so your 1040 doesn't deal with C corporation filing. C corporation filing form is 120. 1120. The S corporation is 1120S. These are the forms. Actually, the best way to learn, I just had a young man ask me a tax form question, ask for what code is that related to. Actually, the best way to search those ones is going to the form instruction. Because when you go to the form instruction, every line they give you an instruction. If you want to know which tax code stipulates that particular calculation, you literally you can copy that instruction to the irs.gov website. It will give you that. So, those are the things. When I do internet search, of course, Google's is so great, right? Give you answer. But just be really careful because sometimes they give you answer that's from Australia. Sometimes they give you answer that only applicable to Poland. Internet is internet. It doesn't have boundaries. So I remember that one time, and I was talking to a client. The client was keep on saying that they should get a $20,000 tax credit, small business tax credit, because that was a new rollout rules from the IRS. And how come you don't know? It's $20,000 is not showing up on my tax return. I was so confused. I was so confused at that time. This was several years ago. Then it turned out to be that my client was searching on Google for small business tax deduction. That 20,000 was for Australian. It's not for American. But of course, the internet don't really tell you it was for Australians. So just be really careful. And when you are looking at certain answers, go to irs.gov. Go to the official website. When you want to learn something, you come to communitycpa.com, because when we put out knowledge like this, number one, we have experience in our practice. Number two, we actually do our own due diligence. If we did something wrong, if we understood anything wrong, we correct that right away, because that's how we practice, that's how we grow, right? So, yes, we might interpret different things. Government new rules come out, everybody is doing interpretation. We do too. Dr. Howe will help us interpret new rules, and we roll out the new rules. But if our interpretation is different from IRS, doesn't mean the IRS is right. It means that we have a time, we need to debate, because court is for that. The tax court is for debate. So we disagree with what IRS is doing. We go to the court. We take commissioner to court, and we fight over that. That's why you have court cases, right? So it is always good that when you are ready to fight with the IRS, fight with commissioner, you actually search in tax court files to see whether someone already fought that for you. Then save your time and money. You can just reference to that fight and then tell the IRS people, hey, here's what I have. We should go for this. And that's how you work with the government, right? So we have rules and regulations, and I hope we continue to have rules and regulations. So those are helping us to practice with certain guidance, and we know how things should work. So I hope this golden triangle business structure, tax structure, and give you a little bit of thinking. Now you're thinking, okay, I already have LLCs with all the properties. I didn't do this management company. When should I do that? And this is where I think you're ready to engage professionals to really get your structure right. I literally get calls, I wouldn't say every day, but every other day for sure. People coming in needing to know the first step. The first step to set up a structure is so important. Do you realize that if you set up a structure right, you could save $10 million when the time comes for you to sell the business? But if you set up the structure wrong, same business, you would lose that $10 million. So those are very deep tax knowledge that we accumulate over 30 years time, right? I started practicing taxes when I was in Canada. So, if I add Canadian time and US time, yeah, 30 some years. And here in Canada is our 28 years time. So, with those years and 12,000 clients, we know what we're talking about. So I hope this offered you a glimpse of hope to save taxes, save it legitimately, and to do your return, do it professionally. All right, and I will see you again. I talk this kind of talk on Tuesday, 3 p.m., and I also do it every Saturday since March 21 of 2020. We have never stopped. I have never missed my Saturday. Occasionally, when I'm not available, and my partners would come in to replace me for that time. And if I am remotely available, I would do it in hotels wherever I were. I have done that in Canada. I have done that in actually just in Canada because I go back to Canada. So with that said, I hope this is a useful session, and give me a thumb up if you like it, and comment on our webinars, and we will answer that for you. And I will hope to talk to you soon. Bye bye. Have a rest of the weekend, a pleasant one. All right. Bye bye.